Okay, so we'll start. First of all, we have some questions to complete, isn't it? Right, let's start the questions quickly and we have to move on to the pricing chapter as well. So, first question. Moravaco. Sorry. I forgot it actually, sorry. So, Moravaco produce a product which has a variable cost of $28, a selling price of $39. Budgeted sales and the production volume for the next month are 18,000 units. Budgeted fixed costs are 121,000 per month. Morava wishes to generate a profit of 11,000. How many units must be sold? So most of you all got this answer correct. So can someone explain how the answer can be derived? Okay, great. So we have two options. Number one, we can go for the CS ratio. So get the CS ratio, then fixed cost 121,000 plus 11,000 target profit divided by CS ratio. Option number two, rather than going to CS ratio, just take the contribution per unit. That means our selling price is 39 and variable cost is 28. So the gap between these two would be the contribution. How much is the gap between 39 and 28? Great. Then 121,000 plus 11,000. How much? 133,000, right? Right. That divided by 11. That will also give you the same answer. The same mechanism. So either way is fine. Either you can take the CS ratio or you can straight away go by the number of contribution per unit as well. Are we good? So what was the answer you got? Great. It was 12,000 units. D was the correct answer. Then question number 2. 4 lines representing expected costs and revenue have been drawn on the break-even chart. So they have been given us a break-even chart. So what are the fields that we might have in a break-even chart? Great. So we will have fixed cost, variable cost, total cost, revenue. These are the fields that we are going to get in a break-even chart. So they are asking which line represents the total variable cost. So how would the variable cost start? It will start from 0. Variable cost will start from 0, not the total cost. Total cost will start from fixed cost, but variable cost starts from 0 because if you don't produce anything, there is no variable cost as well. So it starts from 0. So we have two lines starting from 0, A and C, isn't it? So how to decide which one is the variable cost? The lower one would be the variable cost. Then what would be the higher one? Super. So the one is going up would be the revenue. The one is going below that would be the variable cost. So what would be the answer then? C. Line C. The answer is also C. What is line B would be the total cost starting from fixed cost. Are we good? Right. So the answer would be C. Then we are coming to the interesting question that all of you all found it a little bit difficult to do. So Dillnot co-produces and sells rucksacks and shoulder bags in a standard mix of 3 rucksacks and 2 shoulder bags. So that means the mix is constant. Either way, 3 of rucksacks and 2 of shoulder bags would be there. And information is given, variable cost we know 54 and 32.5 respectively. And we have contribution to sales ratio which is 40% and 50% respectively. The fixed cost is 1,608,900. What is the break-even point in sales revenue to the nearest $100? So how can we do this? We don't know the sales price, isn't it? So how can we figure out the sales price?
From the equation like this, sales minus variable cost is contribution. So we have the contribution in ratio of percent. So with that we have to reduce from the variable cost and add the balance. The balance is the sales cost.
Okay. So simply 40% is your contribution means 60% is your variable cost. Agree? So that means 54 means 60% of your sales price. So if you divide it by 60 and multiply by 100, what will be the answer you get? And that would be the sales price. Agree? Clear? Same thing for shoulder bags as well. So try that and see whether it tallies. Sales price would be 90. So 90 into 60% would be 54, right? So we are in line with the what do you call contribution would be 36. Yes, correct. Fixed cost is given.
But the sale total sales is not given, right?
Yes, quantity is not given, but the mix is there, right? So we can use the mix, isn't it? Because mix would be constant. If the mix is constant, doesn't matter the number of units we produce end of the day, right? Either way, the same mix will be continued. So, okay, let's take the answers here. So I'm going to get the sales price. So how much is the sales price for each product? 90 and 32.5 divided by 50 into 50, 65. Okay. So product mix is 3 from here, 2 from here. Agree? So 3 into 90 would be great. 270, 65 into 2, 130. Contribution also the same thing. 40% of 270 is sorry 108. Then 50% of 130, 65. So this would be the contribution. So this plus this divide. So how much is your CS ratio now? Weighted average CS ratio. 2 to 7. So
270 plus 130 divided by 108 plus
65.
100 by 108 divided by we should calculate the percentage.
No, just take the decimals. 2.31. Oh, sorry, it should be other way around. Sorry. Contribution divided by sales. Sorry. I made a mistake. It should be other way around. Contribution at the top, sales at the bottom. Sorry, my bad. 43.25%. Now divide fixed cost by that. Yep. Great. This one, right? So that would be the answer. So let me explain how we did that. Step number 1 is figuring out how much is the sales price. That is step number 1. So is everyone clear how we derived at the sales price?
Three runs and 3 so 3 into 9 and 65 into 2. Yeah.
So right, let's come back from the beginning. So we don't know the sales price, right? We don't know the contribution as well. We only know the variable cost and product wise CS ratio. That's all we know. So if you take what do you call rucksacks as an example. Contribution CS ratio is 40% and variable cost is 54, means 60% would be the 54, right? Out of sales price, 60% would be 54. So if I want to figure out how much is the sales price, the easiest one would be divide this 54 by 60 and multiply by 100. Agree? Are we good with that? Done? Shohel, are you okay or confused? Sure? Vijay? Sure? Right. So your CS ratio means CS ratio means what? Your contribution divided by sales. Agree? So sales price contribution equals to sales price minus variable. Are we good? So if I can just replicate this here, right? Sales price minus variable cost. If that is the case, this 54 means 60%, isn't it? Agree? If I just solve this formula, this 54 equals to 60% of the sales price. So if I take this 54 and divide it by 60 and multiply by 100, I can get my sales price, isn't it? Agree on that? Everyone agreeing on that? Right. I can do the same thing to 32.5. Then I get an amount of 65. Great. So now we know the sales price. And remember, in the multi-product cost analysis, CVP analysis, we assume the same sales mixture is going to continue. So same sales mixture is going to continue means if we know the sales mixture, even though we don't know the quantity of sales, we can still use the mixture to calculate the VEP, isn't it? So we know the mixture 3 and 2. So that means if our sales price is 90, as we computed just now, 3 of that would be there, right? 3 of 3 products of 90 would be there in our mixture. Agree? Because they are saying we are doing 3 rucksacks and 2 shoulder bags in the mixture. So that means if you take a bulk of 5, out of that 3 would be rucksacks and 2 would be shoulder bags. Are we good? Now we are going to figure out the value of this bulk. So 3 rucksacks means 90 into 3. And 2 shoulder bags means 65 into 2. That is 270 and 130. And rucksack has a CS ratio of 40%. So 270 into 40 would be the contribution. 108. Rucksack 40, no? Then shoulder bags 50%. So 130 into 50 means 65. So now we know the sales, we know the contributions. Then just a matter of calculating the weighted average CS ratio. So our total contribution would be 108 plus 65 divided by our total sales would be 270 plus 130. Then we get a weighted average CS of 43.25. Are we good up to that one? Vijay?
We will divide by product plus
Great.
So fixed cost divided by weighted
Weighted
contribution ratio is
break-even revenue.
So the thing is break-even into contribution ratio is will come to fixed cost.
Yes, other way around. Sorry?
Break-even point will be margin of safety plus break-even sales rate. Sorry. Total sales price will be margin of safety plus break-even.
Yes.
And so break-even point is equal to total sales minus margin of safety.
Yeah, that way also we can interpret. But here we didn't calculate any margin of safety. We straight away go and calculate the, what do you call, BEP, the break-even point. Sure? We are good? Right. So answer would be C. Is everyone clear on how we derived on the answer? Okay, great. Then I'm moving into question number 4. Cummins Co. manufactures a single product which it sells for $5. The annual sales revenue is $80,000 and its annual fixed costs are $25,000. CS ratio is 40%. What is Cummins Co.'s margin of safety? So how do we calculate that? Again, most of you all have given me the correct answer. Just can someone explain how did you derive the answer? Balaji, how about you?
So we are finding the BEP of sales and building the margin of safety formula.
Sorry?
We can find the BEP sales, BEP sales. So, by the CS ratio of the fixed cost. From that we can find the margin of safety.
Okay, great. 8 point. No, the answer should be 8, 21.9. So let's see how to derive that. Yes, Sidhu, can you explain how you did it?
So by we have 60% CS ratio, right?
40%.
With that we can find the BEP sales. Like 60% by CS ratio is equal to BEP.
Okay.
From that we can find the margin of safety formula. Revenue minus BEP sales by revenue.
Great. So we know how much is our contribution for sales, CS ratio. We know our fixed cost. So if we divide the fixed cost by the CS ratio, we will be deriving it our BEP sales. So how much is that? 25,000 divided by 40%.
62,500.
Great. So that is our BEP. But we are doing a sale of 80,000. So the gap between this 80,000 and 62,500 would be the margin of safety. So if I divide that from the sales and multiply by 100, that would be my margin of safety percentage, isn't it? So that comes to 21.9 if I'm not mistaken. Am I correct? So this would be the answer. Answer A.
If we have the profit, how do we arrive at margin?
If you have the profit, then you will probably have your variable cost as well,
Yeah.
and fixed cost also.
Yeah.
So all these three together will be your total revenue. Then once you have the total revenue and the variable cost, you can get the contribution.
Yes.
If you have the contribution, you can calculate the CS ratio.
Yes.
And if the CS ratio and fixed cost is there, you can get the BEP.
Yeah.
Then the gap between your total revenue and BEP will be the
profit to margin.
can do, but it will be a bit of a lengthy backward calculation. So like I said, first we have to figure out our full sales, because you have margin of safety means you have the other components also. Variable cost, fixed cost, those would be there. So all these three together would be your sales.
So profit volume ratio could not be used to arrive at margin.
Can do, but it will be a bit of a tough one. Easy one would be to go by the CS ratio. We have, but not in your syllabus, because those formulas are a little bit complex. So we haven't taken most of the complex stuff into your syllabus. So we are just talking about the basics, how to do the pricing and all.
It's in APM.
Some of these would be in APM, yes. But what I would say is, even in practice, CS ratio would be easy, because you can check multiple mixtures here.
What arrive at the profit and then divided by total annual sales. Right? So we can't arrive with the profit volume ratio to margin of safety or break-even.
Directly we can't do that. We have to go backward calculation if you are using the profit ratio.
We have to arrive at contributions in the ratio, and from that we have to, if we have fixed cost, it is the ratio 20-50.
Yep.
If the fixed cost is not given, what?
In this question, if fixed cost is not given, then we can't do the question. If they are not giving the fixed cost, then they will have to give the margin of safety. One of them they have to give us. Otherwise, we can't complete the question. Okay? One would be there, either fixed cost or margin of safety. If one is there, we can figure out the other one. Are we okay?
In exam, we will get this type of questions also.
Yeah, both sections possible. Section C, they might give the answer and ask you to interpret. Good morning. They might give you the answer and ask you to interpret in section C. And how to utilize that, how to maximize this ratio, how to improve the ratio. Those kind of questions might be there in section C. Are you okay? Clear? Anyone having a doubt on this question number 4? Everyone okay? Great. Then question number 5. The following statements has been made about cost volume profit analysis. So basically the CVP analysis we discussed. Number 1, CVP analysis uses an absorption costing approach. Do we use absorption costing? In CVP, no, right? Absorption was a different costing method. In CVP, we don't use absorption. So 1 is incorrect. It's out of the equation anyway. Second one, CVP analysis assumes that variable cost per unit and the selling price per unit are constant over the full range of production. That's true. As soon as you get to know that is true, just check the answers which one gives 2 as a true one. Only D. So that means D should be your answer, isn't it? Just to be in safe side, let's check the 4th option as well because it says 2 and 4. No? Let's check whether 4 is also correct. So 4 says CVP analysis ignores the impact of changes in inventory. Yes, right? We don't bother about the inventory in CVP analysis. So the movements in inventory handling cost might be disregarded. So 4 is also correct. Then what would be our correct answer? D. 2 and 4. Super. Any doubts or any questions? We are good? Right. So CVP analysis, any question comes in the exam, I hope you guys can tackle with that easily. Great. Then let's move on to the new topic. Pricing. So up to now we have discussed different mechanisms of how to calculate 6 tomorrow. Otherwise you won't be able to finish 7. And you guys didn't send me the answers for 6 as well so far. First you have to send me the answers, then I will tell. Altogether we have around 18 chapters. So by now I'm trying to finish 1 chapter at a day, but it depends on how good you guys are understanding. I can't rush too much as well. If you don't understand, no point of completing the chapter. Right? So coming back to pricing. Up to now, we have discussed different mechanisms of costing, right? We discussed about traditional costing, we discussed about absorption costing, we discussed about activity-based costing, then we went to something called throughput accounting, we discussed relevant costing, then CVP analysis. All these were costing mechanisms, how to figure out the cost and how to manage the cost and how to reduce the cost. These were our focuses up to now, right? But if you are running the business, why do you need to ascertain this cost? What is the purpose of finding this cost?
Find the expense and find where they are spending most.
Okay, so after finding that, now we have done the cost management part. No? After that, what can we do from the cost? Why do we need this cost after that?
To find the profit or revenue and contribution.
Great. After that, we have to decide how much is our sales price, isn't it? Once the costing is done, we have to extend that depending on our expected profit to the sales price. So that is where pricing comes into the picture. So first aspect of costing would be basic cost analysis, what we have discussed up to now. Second aspect of costing would be how to define the sales price. That also you guys have to do, right? The cost managers are the ones who are going to define the sales price. The others can't do that because you are the ones who have the numbers. So now you have to know how to define the sales price. So for that we have different techniques based on the costing mechanism that you are using. Because now we discussed close to 6 to 7 costing mechanisms, right? So each of them had different aspects of costing. Are we clear? So depending on that aspect, your profit margins and how to derive at your profit or your sales price will differ. So that's what we are going to discuss now. How to do this pricing aspect. So first one, the full cost pricing. So here what we do is, we directly get all the costs that we are incurring. We take material cost and the other cost also we are absorbing variable production cost, fixed production cost, variable non-production overheads and fixed non-production overheads. Once we add all the costs, we can call it as the full cost. Agree? On top of that, we can have a markup. That is, what is our expected profit percentage? We can have that. Once you add that to the full cost, we will derive at the selling price. So full cost plus the markup would be equal to your sales price. This is a very basic level of pricing. Are we clear?
So markup will be on percentage on full cost to total cost.
In this concept, yes.
Otherwise it can be on selling price.
Selling price, then it could be, if it is on the sales price, it will be called as margin. So we have two different words, markup and margin. If it is on the sales price, it could be margin. If it is on the cost, we call it as markup. Are we good? Clear?
So one product can have both markup and margin.
Yes, two different percentages too. Because markup is as a percentage of cost, margin would be as a percentage of revenue. So markup, you can simply get the cost and apply the percentage. But margin, other way around, because now sales price is including your profit. So you can't just apply the percentage, you have to divide. Are we okay? Clear? Right. So we have a small formula here. Total budgeted production cost plus total budgeted non-production cost plus markup. That will be your total sales. That divided by budgeted number of units would be your unit sales price. So basically the total cost, production cost and non-production cost plus the markup would be your total revenue that you are expecting. If you divide it by your budgeted number of units, that would be your unit sales price. That's how we are going to use this traditional costing method when we are deriving at the price. Are we good? Any questions up to now? Right. Then what are the advantages of this full costing method? Number one, definitely you will be focusing on budgeted sales target. So your focus will be purely on how to arrive or how to achieve the budgeted sales target. That is clear and cut because your price is also derived based on that. Are we clear? Right. Second one, this is purely based on the readily available cost factors. So the subjectivity involved is very less. The numbers are purely the numbers that are available for us. So no estimations except for the budget. Are we okay? Right. And usually this is a good mechanism if your fixed cost represents a high amount. Because if your variable cost is having a high amount, then you don't need to bother about this technique, right? You can simply use something like the CVP analysis easily. So this component comes into the picture if your fixed cost is higher, because your markup should be able to cover up the fixed cost. You can't just add a profit margin to your contribution and go ahead now. Are we clear? Right. Next one, useful for justifying prices and potential price increase. Yes. Easily you can do the price increases because it's purely based on your full cost. If your cost goes up, you can keep the same margin, your price will you can keep the same markup, your price will automatically go up. So it's not a big deal to make the price changes. Finally, very simple, even a layman person can do it. We don't need a ACCA member to do a full cost analysis. Isn't it? Are we okay? Right. Disadvantages. Accounting principles will have a huge impact because now we are going by the full cost. So these absorption costing and fixed costs are coming from your accounting system mainly. So now we are heavily depending on your accounting standards and accounting system, which might be questionable because you use accrual basis in accounting, not cash basis. So these costs might be not incurred. Some of these costs might not have been incurred even by now. Agree? So we have a set of loopholes, a set of framework, a set of boundaries in traditional accounting. So those will be reflected in your costing mechanism also because you take the figures from your accounting system. Are you okay? Right. Second one, operating below the budgeted sales may lead to a loss. So whatever you done, you have to make sure you achieve the budgeted sales units. Because even if one unit is less than that, you don't have any buffer, you will be at a loss. Because you exactly went ahead with your budgeted sales. So small movement in your actual sales compared to your budgeted sales will result in a loss. Because your buffer is very tiny here. Are we good? Srujan, are you okay? Great. Third one, external factors like demand, competitors' pricing, these are not considered. But in the modern world, we can't just disregard these factors. Just because we need to produce 10,000 units to have a profit, that doesn't mean the entire 10,000 will be purchased by the market, right? What if they don't purchase? What if after we do this entire analysis, my competitor's price is half of my price? Then will the people buy my one? No, right? They will go for the competitor's product. So we have a big issue where we disregard all these market factors in this full cost pricing method, which might create problems for us in future. Are we good? Right. And the markup percentage is arbitrary. Anyone can say any markup percentage. There is no fixed method of deriving how much should be your markup. It's purely based on how much of profit you need. Agree?
What is arbitrary?
Arbitrary means just decided, random. So there is no fixed mechanism to derive the answer. It's a random markup, random percentage. That's how the markup works, right? We didn't have any arithmetic or mathematical method to calculate the markup. We just went ahead with the arbitrary profit percentage, isn't it? Agree? Kaushik? Right.
Let's say, for example, when it is we have so much stock. If a stock is lying unsold, which what they will do?
They have few options. We will discuss those at the latter part of the handout, but just in a summary, one they can do is go for discounts. Because in a expire.
Yeah.
Before expiring,
In a supermarket, they are not bothered about whether expired or not, because if it is expired, they always have the right to return it to the manufacturer. In supermarkets, it's not a big problem for them because the agreement is such: if the products are sold, they will pay the supplier. If the products are not sold or expired, they always preserve the right to return the goods to the supplier.
So they won't incur any losses except for fixed costs.
Yes, fixed cost and staffing cost. Putting up a supermarket is tough, but managing compared to other business, it's easy. Because usually you keep a 3-month working capital cycle as well. You don't pay your suppliers until 3 months. Even after 3 months, if the product expires or not selling, you can return the product. So in that way, supermarkets are always safeguarded. If it is expired, they have to bear the loss. If it is not expired, either they can reproduce or they can suggest the supermarket itself to go for discounts or bundle the product with something else. For an example, let's say you're talking about a toothbrush, which is going to be out of fashion now. Because nowadays, the young generation, even in the toothbrush, they watch about the fashion, right? How it looks like. So these kind of problems are there in the current market. So if it is going out of the market, the easiest way is bundle it with a toothpaste. So we can say if you purchase one at a time separately, toothpaste would be 20 and toothbrush would be 10. If you bundle the both together, we can say we are giving it at 25. So 5 rupees saving. So we can bundle and give it. So these kind of options are there if it is nearing to the expectation. And we can issue with staff as well at the cost to reduce the loss for us, because we are covering the cost, means the loss is minimized, right? So we can issue for the staff at the cost as well.
So market price tell the discount from product expired expiration. The discount will be faced by the supplier or the supermarket.
Again, discount, there are two kinds. One, supplier driven discounts. So that one, the supplier will make the call. But in certain cases, supermarkets also define to go for promotions. That is to build up their brand name.
Recently, my canteen owner asked me to review a product. They are selling a product exchange, and for two products, Nandari and another one is some protein food. Okay. So the thing is, they are tying up with Reliance market, and Reliance market goes for 65% for their margin from MRP. And now they are tying the both products together and going for 1+1. But the thing is, Reliance market's margin will come down, but the supplier has to back the cost. Supplier has to back the cost for reducing the MRP.
Yes, there are two kinds, like I said. If it is supplier driven, then the supplier has to bear the cost. Sometimes certain supermarkets, in certain cases, they want to build up their brand name. So in that case, sometimes they incur the cost as well. So usually if you pay by the credit card, there would be 3% charge, right? Normal context. But these larger companies, larger supermarkets and these pillows, they bear that 3% for you, right? Bank is not going to give that 3%, right? They are not going to waive it off. Just the supermarket is bearing for you, just to boost their sales. So it's a quantity problem. So they are trying to increase the quantity. So that also can happen. So can be two types of discounts given. Certain, if the supermarket requires that, then they might bear the cost. But if it is for supply, then definitely supplier have to bear the cost. Or sometimes together also they can do it. There are certain promotions, certain discounts where both parties get together and do it. That also can happen. Are we good? Right. So the last disadvantage of having this full cost pricing method is profit maximization is not guaranteed, because we purely disregarded all the market factors. So sometimes our price might be out of the world, might be very expensive. So profit maximization is not guaranteed. Are you okay? Clear? Srujan? Ethan? Great. And this full cost pricing method is a long-term one. It's a long-term strategy, because we are looking at the overall cost, not the moving cost. So overall cost cannot be achieved over the blue moon, right? Out of the blue moon, today we decide, okay, full cost pricing would be done, and by tomorrow we can't achieve the entire fixed cost, isn't it? It will take time. So it's a long-term strategy. Full cost plus markup method. Full cost pricing method is a long-term strategy. We can't do it in the short term. Are we good? Clear? Right. And differently, so here we absorb the cost, right? Sorry. If you check the wording, we are absorbing the cost. Correct? In this first method that we discussed, we are just absorbing the cost, isn't it? But apart from doing that, we can use activity-based costing here as well. So the cost absorption we do based on the activities. Again, we calculate the full cost, but not on the absorption method, but on the ABC method. So based on the cost drivers, we absorb the cost now. The same formula will continue though, but the cost numbers might change. Are we clear? Because now the method of absorbing, method of allocating the cost is different. Earlier we just used the number of units or whatever, number of units or space or number of hours or whatever. But now for each activity we are going to use a different cost driver. As a result, the cost might be changed, but still the overall function, overall formula is not going to change. Full production cost plus full non-production cost plus markup divided by the budgeted sales. The formula is not going to change, but the cost figures might change because the way we allocate the cost have changed now. Are we good? Shohin, are we okay? Great. So what are the advantages of using ABC for full cost pricing method? Number one, now markup is going based on the contribution, isn't it? Because ABC is going on the contribution. So now this we can align to the short term as well, because now we have both figures. We have the contribution figures, we have the full cost figures. So we can have the long term strategy as well as the short term strategy now. Are we good? Sidhu? Right. And fixed costs are treated based on their nature. Now random allocation of fixed cost is avoided. Arbitrary allocation of fixed costs are avoided now. Now fixed cost will be allocated based on cost drivers. That means more or less we are trying to relate the cost to the respective product accurately rather than just allocating it. Are we okay? Right. Disadvantages. Sometimes we might not be able to cover the full fixed cost in ABC method. Are we okay? Second one, unsuitable for long-term pricing because we are going by the contribution, we are going by the variable factors. So short-term orientation is there. Are we okay? Right. So whatever we are discussing right now are the traditional mechanisms. Huh? Next one is the traditional ROI method. Can you guys recall ROI in your financial accounting? Great. So we are talking about return on investment. So capital employed divided and return divided by the capital employed, isn't it? Or the expected return on what we have invested. That is our ROI. Based on what we invested, how much are we expecting to get the return?
Budget full cost is that comparison of both variable cost and fixed.
Full cost is both variable cost plus the fixed cost. Are we okay? Right. So simply in this case, what we do is we take the budgeted full cost and add the profit now, but now the profit calculation method is not a markup. Now profit calculation would be your return on investment method. So that means your capital employed into the expected ROI. Are we good? So your ROI is completely depending on the attitude of your investors. Clear? Any doubts? Yes, capital employed would be your investment, but it's a bit of a subjective one. In your exam, don't worry, they will give straightforward ones like equity, shares, reserves. They directly give you straightforward ones in your exam. In accounting, this would have been a bit of a complex area because weighted average stuff are coming in, preference shares, whether it is equity or debt is coming in. So in financial accounting, capital employed would be a little bit of a confusing or complex area. For PM purpose, you will be given with straight numbers. Are we good? Right. So the formula would be budgeted total cost plus capital employed into ROI divided by total budgeted sales units. Are we okay? Vijay, are we good? Sure. Right. ROI again is a long-term one because it's coming from the investors. So investors will be having long-term goals, right? So the percentage of return they are expecting is a long-term percentage. So ROI is itself is a long-term one. So that means the pricing will also automatically become a long-term pricing method. Thus, we are using the full cost. As soon as we use full cost, automatically it becomes a long-term oriented pricing mechanism. Are you okay? Great. So what are the advantages of this ROI method? Number one, it links price to both short-term and long-term capital employed. So we are taking the full capital employed. So short-term and long-term both are taken care of, though our objective is long-term. Are we good? Right. Second one, consistent with ROI as a performance measure. So in your financial accounting, you will be using ROI as a KPI, right? Key performance indicator. You would be using ROI in your financial accounting for sure to assess how your managers, how your directors has performed their job, isn't it? Now we are aligning our pricing to ROI. So obviously the possibility of satisfying your investors is high because we are trying to achieve their expected return. Are we okay? Okay, are we good? Great. Third one, target ROI can be set to account for risk. So when you are deciding ROI, just rather than just getting the expected return from the investors, we can add a little bit of a cushion considering the risk factors that we are facing. So now certain risks also we can allocate for ROI so that we will have a bit of a cushion rather than in the full cost method. Are we clear? Kirtan, are we okay? Great. But as usual, it has some disadvantages as well. Here also, except for the investor aspect, all the other external factors we are disregarding. We are disregarding the competition, we are disregarding the customer expectations, we are disregarding the demand, we are disregarding the environmental factors, all these we are disregarding. Next one, challenges in calculating capital employed. Like I said, even though in your exam the figures they are giving is straightforward, in practice the financial accounting would be the one that is calculating capital employed, right? Which is going to be complex depending on the structure of your company. Because some might have convertible preference shares. So do we take it under capital employed or not? Question mark. These kind of complexities might be there in defining how much is the capital employed. Are we good? Then it involves subjective allocation of shared investment among the products. Now the investment we have to allocate among the products, right? That's what we are trying to do. But again, how to allocate is subjective. You are the one who's going to decide. So in that case, Praneeth's opinion might be different from Balaji's opinion, isn't it? And Balaji's opinion might be different from my opinion. So each one might have their own opinions on how to allocate the investment. Then it's a question mark again, subjective. Are we good? Present? Sure? Great. Then we have an example for cost plus and target ROI method. A golf club manufacturer is about to launch a new product, the Wild Thing driver. Buildings and equipment needed for the production will cost around 2 million. And a working capital requirement is estimated as $10 per unit per annum. So these are all your investments, isn't it? Buildings is your investment. Working capital is coming from your investors. No one else is going to give you money, right? So these are your investments. And then expected sales levels are 40,000 units per annum. Variable production cost is $30 per unit. Fixed production cost would be 300,000 and fixed non-production cost would be 100,000. Requirement A, calculate the selling price using full cost plus 20%, marginal cost plus 10%, target ROI plus 10%. Can you try part A first of all?
The investment doesn't come under cost base.
No. So try part A, 2 minutes for each calculation. So maximum 6 minutes. These are straightforward stuff. So we have to now try to do within the time. So 6 minutes guys, 2 minutes for each. Online students, please try this and share the answers in the chat. Guys, your time starts now. Individually give it a try. Shall we start? Right. So full cost plus 20% means first of all we have to figure out how much is the full cost. So variable cost is given, right? 30 per unit. It is given. Then full cost, the fixed cost we have two kinds. Production, non-production. So the production fixed cost was 300,000. Non-production fixed cost was 100,000. Agree? And we are looking at 40,000 units. So that means per unit it will be around 10. Agree? Right. Then full cost would be $40 per unit and 20% of that would be 40 into 20, that is 8. So the sales price in first scenario would be $8. I mean $48. Are we good? Suhail, are you okay? Vijay? Kirtan, are we good? Right. Second method, we are going by the marginal costing. So marginal costing means we are going to only consider the variable cost. So variable cost is given, that is $30. So 30 into 40% means 12. So the pricing would be 42. Final one, ROI. For ROI, we have to figure out how much is the capital employed. It means how much are the funds the investors has brought in. Buildings, who's going to give? We are a startup, right? So the building, who's going to invest? Investors could invest, isn't it? Because we are just a startup, we don't have money to invest. Investors will invest in the building right now. So 2 million will be a part of capital in that case. Similar to the working capital, because we are just starting, so the working capital will also be funded by our investors, isn't it? Because we don't have any revenue to fund our working capital right now, right? It's a new venture that we are talking about. So our investors are the ones who are going to pump money to our working capital also. So they are saying working capital is $10 per unit. So 10 into 40,000, 400,000 will also be invested by the investors. So that means total capital employed would be 2.4 million. And 10% of that means 240,000. Are we good? And 240,000 divided by 40,000 units means 6 per unit. And we already know how much is the total cost, that is 40. So 40 plus 6 would be 46.
Which one is the last one?
The last one, yeah.
On the last one, sir, below target ROI.
Below?
Target ROI, sir. This one you said, right?
Yes, that's what I was saying.
Because this one, we need to find again.
We need?
Variable cost. Someone said it again, sir.
So I'm in here, that ROI method, I'm on that. Right. So what I did was, first of all, I tried to figure out how much is the investment. So we are a startup now. So buildings will be coming from the investors. So 2 million will be part of our capital employed. Since we are a startup, Working capital also we are not in a position to fund. So that will be also coming from my investors. So $10 per unit is the working capital. 10 into 40,000 would be 400. So altogether my capital employed would be 2.4. And my ROI I am expecting 10%. That means 2.4 million into 10% would be my total profit. So that is 240,000. But that is for 40,000 units. So if I divide it by 40,000, I can get the unit profit I am expecting. So that would be 6. Already I know my full cost. That is 40. So
in that way,
yes. So 40 plus 6 would be 46. Are we good?
per unit. Now, what was the minimum?
Okay. Right. Praneeth, are we good? Great. Then let's move on to part B. If actual sales units are only 20,000 and the selling price was set using full cost plus 20%, calculate the profit. 2 minutes, we'll try. 20,000 units, 40,000 loss. Right. The others also take 2 minutes and try to figure out the answer. Max 2 minutes, guys.
Sir, I have a doubt.
Yes, please go ahead.
We go for selling, if we go for actual selling, for selling is a problem. If we can only produce 20,000, I mean, if the actual sales are right 20,000, can't we just absorb both variable cost and fixed cost over the 20,000 units and add 20% to it and allocate profit cost?
We can do, but by the time we know the actual sales, the sale is already happened, pricing is already happened, right? But based on that, for the next year, we can revise the price. Are we good? We can do a price revision, but whatever happened, we can't change it because the sale is already happened. Are we okay? Right. Guys, 2 minutes, complete the profit figure. Guys, 2 minutes is up. Has everyone derived the answer? Profit?
Minus 40,000 loss.
40,000 loss. Kaushik, you also got the same answer, right? You also got the same answer, right? 50,000 loss. 40,000 loss. Okay. Balaji, same thing. Praneeth? Sujan and Keerthan? Okay. Shall we discuss that? Right. So simply, sales is 20,000 into 48 because our price would be 48 now. Variable cost 20 into 30, which is going to be 600,000. Fixed cost, it's not going to change, entire 400,000 would be there. And as a result, the net profit would be at a loss, 40,000 loss. Are we good? Right. Next one is opportunity cost pricing, the next mechanism that we have to think. So we already discussed this opportunity cost somewhere. Can you recall where? Yes, economics we did, but in performance management also opportunity cost we have discussed a little bit earlier. Great. Under relevant costing we did that, isn't it? We discussed about opportunity cost under relevant costing. So the same principles apply, but this opportunity cost using it in day-to-day one is going to be a little bit tough. This can be mainly used for one-off projects, special offers and tender quotations. So for day-to-day pricing, this opportunity cost method is going to be a bit of a hazard. So we are mainly focusing on what you call specific stuff like special projects, specific orders and tendering. So what we are going to do is we take the relevant cost and add a markup to that. Are we good? Right. So relevant cost basis provides minimum price that can be used as the basis for the quotation. We already know that. In the relevant cost chapter, we spoke a lot about. Are we clear? Right, now we have a question around this. Don't try this. Can you read this? Can you read the question? Take 2 minutes and read the question, then we'll do it together. So after spending $500 on a research, the Bobco Engineering wants to build an important one-off contract and needs to ensure its costing is both competitive and commercially rational. To complete the project, it will need to devote the following resources to its construction. Number one, 1,500 kilograms of standard steel are regularly used in its production process. It currently has inventory of 6,000 kilograms purchased at an average price of $8 per kilogram. With recent market conditions, the purchase cost is now at 9.35 per kilogram. So what is the relevant cost here? 9.05, 9.35. 0. Relevant cost is 0. Right. Let's check on that is already incurred. So already incurred means sunk cost. Are we good? Right. Pranit, what is your answer for the first one? 9.35. Vijay? The answer for the first point. How much is the relevant cost per unit? I'll give a little bit more time for Sidhu and Vijay. Just think around. I'll come back to you guys. Kaushik? Okay.
I don't know what relevant cost.
Right. No problem. Just try to check the recording when you get a time. Balaji? What's the answer? The relevant cost. 4.8. Okay. Balaji? Same answer. Student? Same answer. Per unit I'm asking, guys. 9.35. Kirtan? 9.35. So yes, I go ahead with 9.35. Why? Agree, it is in the stock. True. But this one is regularly used in our production, right? That means if I divert this from inventory to the new project, still I have to purchase at 9.35 for my existing production. So either way, I have to incur 9.35, isn't it? Either for the new project, I have to purchase at 9.35 from the market, or the existing one I can use, but still the amount, the 1,500 kilograms that I use for the existing production, I have to refill it, right? Because it's continuously used in my other products.
If they told us the production may regularity of products, say for example 1,500 kg per year, will the answer change?
If the volume we have is, so regular production, let's say another 1,500 is required,
Yeah.
but we have 6,000, right?
Yeah.
In that case, it would be 0 because we don't want to replace, no.
So the period is not given.
Period is not given, but they are saying it's continuously used. So continuously used means whatever we have, we will be using.
So we are assuming that 1,500 kg may be used this month. So in a year,
Yes. So if it is in the regular use, that means if we take from the existing inventory, we have to replace that. If it is not, no, it's not about the period. So the decision making factor would be whether we use it in the regular production or not. If we are using in the regular production, if whatever we have in the inventory, we will be using for produce other products, right? So if I,
if the period is different, so the period is not different, but if the period is different, and we just take 1,500 kg per year, say for example, we have to test around 3,000 kg. and we need 1,500 per acre. So will the opportunity cost change now?
Yes, in that case you can say 0 because we have excess in the inventory.
Yeah.
But right now there is no excess. In that case, there would be an excess of 1,500. No? We have more than what we need. Then the balance we can use for our production at a 0 cost. Are we good?
Yes.
Right. So first one would be 9.35 per kg. Are we okay? So the total would be 1,500 into 9.35. Great. Then second one. 500 kg of special steel. It has 500 kg of such steel in the inventory. This was purchased 16 months ago at $12 per kilogram. As it has not been used since purchasing, the auditors insisted on a write-off to estimate the net realizable value of $4 per kilogram. The purchasing manager figures that he can sell it at a scrap of $2 per kilogram. If sold, the cost of remove it from the warehouse and delivery would be 1,000. So what would be the relevant cost?
2,000 and 0. No, it's 4. But they are not using the scales. Just
Yes.
the
Let's go one by one. So first Vijay, go ahead.
selling the scales. But for selling also they want that.
Yeah.
0.
0.
1,000 is expensive.
1,000 expense. So cost would be 1,000. Right.
In this case, they are giving both the
In this case, we have to consider scrap because NRV here is an accounting figure, not the market price.
it is not related to this one.
Yes, it's an additional information given to confuse us.
It's a case that we should take the cost access testing.
Yes. Partially correct, not correct. Guys, so what are your thoughts?
The opportunity cost would be higher.
You are trying to compare the scrap value and the NRV.
Yes.
In this case, NRV is an accounting figure, not the actual NRV. Because NRV is the price at which we can sell at the market technically, right? But we are saying what we can sell is only $2.
Yeah.
So that means this $4 is an auditor's estimation, not the actual market price that we can sell.
Sir, but
We have to consider NRP or
sir, but the 12 is a sum cost, so how can we compare the cost of scrap?
12 is not a problem. It's a sunk cost, so it's out of the equation anyway.
How can we compare the scrap value?
So in this case, we don't have to compare anyway. Because first question, let's clear out what is this NRV issue. So Kaushik, if we take this NRV,
so selling price minus expected cost of selling.
yes.
So NRP itself will be 0, right? Because I can sell the scrap at $2 per kg, and $500 into 2 is 1,000, right? And the expected cost for remove from the warehouse is $1,000. So NRP is 0, right?
Exactly. I agree with you. So that is the answer in this case. So the NRV given $4 per kilogram is not relevant. That is an accounting figure estimated by the auditors. It's not the actual market price. So that is also out of the equation. $12 is also out of the equation. It is the original cost we purchased. So that is not relevant now. It's a sunk cost. But we have a scrap value. If we sell this, we can earn $2 per kilogram. So that means we have an income. 2 into 500,000. So that income we can take. But if we sell that, to deliver another 1,000, we have to incur. In that case, like Taushik said, 1,000 to 1,000 will be set off. So it will be 0. The net impact would be 0. But in the exam, show both separately to communicate to your examiner that you understood both aspects, not that you missed it. Auditor's one you don't have to consider. Scrap value and the delivery price. So, net impact would be 0. So 1,000 plus inflow from the scrap sales, 1,000 minus for the expense that we have to incur to deliver it. Net impact would be 0, but show the both lines. Yes, but like I said, make sure you have both lines, because your examiner, we have to communicate clearly to him. We knew the concept. So if we just have a 0, he doesn't know how we derived at the 0, right?
If two costs are given, one is lower and one is lower. What would the relevant cost would be? Lower or higher?
Would be lower, because you will be going for the lowest option, right? As a business, we will go for the lowest cost. So always it's the lower cost wise. Revenue wise, higher. So both ways the question might come. Are we good? Right. So second point is everyone okay? Right. Third one. 380 hours of unskilled labor. Although the current trade union contract pays $6 per hour for such labor, extra workers would have to be hired temporarily from the labor market at $7 per hour. So how much is the relevant cost? Great. 7 into 380 hours. That would be the relevant cost.
What is the 380 to 7?
380 to 7. So 380 is given in the question. 380 unskilled hours are required.
Extra workers, right? So we have to pay
Sorry?
there's an extra workers to be hired temporarily because they need extra hours.
Yeah.
But it's not like an option, sir. You have to choose 6 hours. It's not like that.
No, it's not an option, because if we take the current people for the existing new project, then for the existing project we have to bill again at 7. So then it will create an opportunity cost.
How are you supposed to choose that, sir? How are you supposed to choose that?
So it's like this. You have to pay me 1,000. I have to pay you 1,000. So will you just choose or will you just set off? Will you set off, right? And now as you are in a project, you have two options. Either you can use Kirtan at a rate of 6. But if you use him, for his job, you need someone else, right? So let's say you have to hire Balaji for that. Again, for him, you will have to pay 7. So either way, your cost is 7, right? So there is no choice here. If you use Kirtan for the new project, then you need Balaji for the existing project.
Have to be hired.
So either way, you have to pay 7. So you have two options. Either you can have a long route where you take Kirtan and replace by Balaji, or you can straight away allow Kirtan to go ahead with his current project and straight away take Balaji to your new project. Clear? Sidhu, are we good? Are we okay? Right. So 380 into 7 would be the relevant cost for the unskilled labor.
They should be paid at the 6 per hour.
Yes, then 6. Yeah. If,
For the labor available and for the labor behind, they should be.
yes. Then whatever you can take internally, the idle labor, since it's hourly rate, you can take at 6. If it is a fixed one, then cost would be 0. Then whatever you take from outside, you will have to pay 7 per hour. Are we good? Right. Then the next one.
Have to be hired. Compulsory we need some workers.
how your exam would look like. So you have to be careful on the wordings. Are we good? Right. Then next one. 196 hours of semi-skilled labor paid $9 per hour under the current trade union contract. Currently, there is surplus of such labor in the plant. So what's the relevant cost? Zero.
How to pay in the current rate? What about the surplus? What does that mean?
Surplus means excess.
There's no relevance.
No relevant cost. Everyone is in the same way. Guys, we are paying at $9 per hour, right? Currently, we are not using is, are we paying for them currently? So let's say for me, for an example, so I have hourly rate, right? Even though I'm available in the afternoon also, I'm not conducting any lecture. So just since they have me idle there, are they going to pay me for the hours that I'm spending at the apartment? No, right? So that means if it is an hourly rate, if you use that hours, you have to pay the hourly rate. Agree? So even though they are idling, for the idle hours, we are not paying now. It's not a fixed price, it's an hourly rate. So now we are going to use them. So the hourly rate we agreed we have to pay now. So the $9 we have to pay. $9, no? Yeah, $9 we have to pay. Agree? Okay.
But in this case, the extra cost will be yourself.
No, it's like this. Again, take an example. Now I hire you as a consultant, right? So if I hire you as a consultant, I will be paying you on hourly rate. But that is only based on the hours you work, isn't it? If you have any excess hours, I'm not going to pay for you for that. So if your working hours is 8 hours, but still you have only worked for 4 hours, I'll be paying you only for 4 hours, not for the entire 8 hours, isn't it?
Instead, if you work for 9, the extra 1 hour will not be paid.
No, extra hour I will be paying. But if you haven't worked for the 8 hours, I'll be paying only for the hour number of hours you have worked, right? So here also the same thing. They are not working right now. They are idling. But if they are idling, I'm not paying them as well. So this 9 I'm not incurring right now. But if I go for this new project and I ask them to work, this 9 I have to pay them. So it's an incremental cost for me. So incremental cost is a relevant cost. So 9 into 196 hours would be my relevant cost. Sindhu, are we good? Still not clear. Sir?
In answer to say zero.
In
In answer down, it's 0 for the semi-skilled level.
semi-scale level?
0 is done.
No, it could be 9 because it's an hourly rate, right? So if you are not using, you are not paying. If it is a fixed salary, yes. Now let's say I am paying you 100,000 per month and you have excess hours. Then I can use you, right? I don't have to pay you excess, no. I'm not paying any additional amount for you. You are having idle hours, I'm using you. But if I'm paying an hourly rate to you, if you are not working, I'm not paying as well. Now, if I'm asking you to work for a different project, still I have to pay you that 9, right? Agree? Or still not clear? Clear? Sindhu, how about you now?
What about the previous question for the $6 pay?
Previous one, what happened was we don't have excess. So whoever we are having is already working in the project. So for the new project, I have to hire from the outside. So that's why I went for the market rate.
Give me the example, the scenario in which the relevant cost is 0, so that I can understand this.
Okay, so relevant cost would be 0. Now assume I take you as a consultant, but what I pay you is a monthly price. Monthly amount. It's a fixed salary per month. Let's say I'm paying you 100,000 per month. In that case, if you have idle hours and I ask you to use that idle hours for a new project, my cost is not changing, right? Either way, I have to pay you 100. But in this case, it's not like that. I pay you per hour. So if you don't work, I'm not paying. So that means if I ask you to work, that whatever the hourly rate I'm paying you will be a relevant cost for me. Are we clear? Are we good? In the question they will mention. So this one they are saying $9 per hour. No? So that means it's a hourly rate. If it is a monthly one, they would have given us the monthly amount. They have to mention it, yes. Then it will be zero. Yes. Because anyway, I will be paying the monthly salary irrespective of whether you work or not. Are we good? Sidhu, are we okay now? Kirtan, are we good? Right. Next one. 51 hours of labor paid $18 per hour under the current trade union contract. The workers are currently busy in another department where they are producing output which is sold at $96 per unit, and it uses $15 of direct material, $9 of skill labor, $27 of semi-skilled labor, and $15 of variable overhead, and $8 of fixed overhead cost allocated. It takes a half hour of skilled labor to produce on this existing product. The department head has agreed to release his skilled workers, but he must be compensated for the loss that he is incurring. So here we are talking about the opportunity cost, isn't it? So under the opportunity cost, we have to consider the contribution of this existing product. So we have to take the sales price which is given and all the relevant variable costs we need to deduct. Are we good? Then we will derive at the contribution. And that will be the relevant cost now. Isn't it? Agree? Everyone clear? Can I move forward then? Right. Sorry? Right. So here what happens is, now let's say you are doing, let's say you are in a project called Project A. Or you are lecturing, let's say you are lecturing to CA. Now we want you to come for ACCA. But you don't have spare hours. So if you are to do ACCA, what you should do? Stop CA and come to ACCA because you don't have sufficient time. But from Arivu's point of view, if they are to deploy you from CA to ACCA, whatever the contribution you generate, whatever the profit you generate in CA should be greater than what I get from ACCA. So to define that, to price my ACCA course, I have to make sure whatever the amount of profit you brought me in CA needs to be added to my cost, isn't it? So that is what we are doing here. So we have the sales price. From that, we have to deduct all the relevant variable costs. Fixed cost is the allocation, right? So that will anyway be there, irrespective of whether you do CA or ACCA. Fixed cost would be there anyway. Agree? So we take the sales price, we take all the variable costs, and we take the contribution. That contribution would be the relevant cost in this scenario. Are you okay? Suhail, are you okay? Okay?
Yes, sir.
Great. Sujit? Right. Then I'm moving on to the next one. We'll complete this question and go for the break. I heard someone mentioning break. Right. The next one. Use of equipment which has scheduled to be disposed of this period for $12,000. If used in the project, it will have to be disposed later at an estimated selling price of $4,000. So what is the relevant cost here? Great. It would be the opportunity cost. If we sell it today, we can get 12,000. But if we use for the project and sell it, then only 4,000 we are getting. The gap of 8,000 we are losing. So that 8,000 would be the relevant cost when we are defining the cost for the project. Are we good? Right. Next one. Exclusive use of a piece of manufacturing equipment which will not survive its use in the project. So that means after the project that will be out. Yep. The machine originally cost $51,000 and currently has a carrying value of 6,000. Either of these are relevant for us? No, right? Cost is sunk cost. Carrying value is the accounting value. It should be current. It could be currently sold at 6,000, and it was left in its existing use. It could generate cash flows with an estimated present value of 5,000. What would be the cost?
3,000 is the
3,000.
net cash flow of 5,000.
Mhm.
Sales value is 3,000.
It can't be sold for 8,000.
Right. Let's come to the question. We had a decision making factor, right? When we are deciding whether to sell an asset or keep it. So, as a business, when you are deciding, you will go for the highest return that you can get. If you continue to use the machine, you can get only 5,000. But if you sell it now, it will be 8,000.
What?
Yes.
Here also we different strategy.
Sorry?
Anyway, it's like 5,000.
No.
But there is no sale value of
So if we use it, after that there is no sales value. So if you use it, only 5,000 would be your future cash inflow. That's the economic value we discussed. And your sales price would be 8,000. So once you compare these two, you will go for the highest. But now if you are using this for the new project, this 8,000 will be lost. So that will be your opportunity cost. Are we good? Okay. Sure. Ethan? Right.
So we don't consider the new what we are doing.
No, that is not relevant because we haven't decided whether we are going to use that or not, what we are going to do with that. Nothing we haven't decided, right? So that won't be coming into the picture. Are we okay? Right. Last one. 38 kilograms of ecotox, which was originally purchased for $600 per kilogram. Under the current government environmental rules, WAPCO will have to pay $3,000 for recycling the company to take it away if it is not used in the contract. So that means we have paid $600 per kilogram. And according to the government rules, if we are not using this, we have to spend $3,000 more for recycling it. So what's the factor here? 3,000 plus or minus? Right now we are not using.
But we have purchased it.
They have purchased sometimes back. We have it in the stock.
We have to recycle it again.
If we are disposing it, we have to recycle it. If you are not using, we have to recycle it.
We purchase it, we have to recycle it.
No, it's like this. We have purchased with already in our inventory. Now the question is whether we are going to use this or not. Are we good? So if we don't use this, we will have to spend $3,000 to recycle it.
So we have to
So using is benefited for us, isn't it? It is going to save us $3,000. So that is going to reduce my overall cost by 3,000 of the project. Are we good? Clear? So are we good with this kind of a question? This might be an exam type question. This kind of a question might be there for 10 marks in the exam. Are we good?
10 marks.
Yeah. Right. Now the topic is how to use life cycle costing in pricing and what are the limitations of doing the same. So if we take life cycle costing, now we know what it is, right? Life cycle costing was all about considering the entire life of the product, and based on that we assess the cost. That was the life cycle costing. So how to use that in pricing? So we already decided how much is the cost. We already know how much is the unit that we are planning to sell. throughout the entire lifetime of the project or the product, then just to add a margin or a markup and divide by the number of units. It's very easy. Are we good? Right. So now instead of having the total cost, we are having the life cycle cost, which is talking about the full cost for the entire product life. Are we okay? Right. So what are the limitations of doing this? Are we didn't do this? We discussed, right?
How we got the appraisal result? We have discussed.
How do we go?
Appraisal result.
Price in sense?
See, there is the answer. The physical level is 0.
No, that's wrong. We have to have that. I mean, while explaining, I told you guys, because if it was a fixed monthly salary, yes. But in this case, it's an hourly rate, no. So this cannot be 0. So we have to have the amount. So then this final number should change here. I will share the amended answer with you all. This is straight away from the study hub. So it might have certain changes. Couple and also the same thing. If you take the study text, there are certain errors in the answers that they are making. So this is a small mistake that has happened. So it's not 0. Like I said, 9 into number of hours should be there. Then the total cost will be slightly different from that. For that, just add 25%. That will be the markup. Then we can get the bid price. Are we good?
How to find the price?
In this case, it's not a per unit one. It's a full contract. So it's the contract price. It's like constructing a road. There are no units. For the road, you have one contract. The total cost for the contract. Are we okay? Right.
What is the opposite of for skill level?
Which one? This one.
Working
So that is the working that we calculated that what you called for skill labor, the contribution story that we talked about, the contribution loss. So this is the contribution calculation. So 96 is the sales price. So we took out direct material, skilled labor, semi-skilled labor, and the variable overheads. This is the unskilled labor one. Sorry, a skilled labor one, where we are trying to take them for a different department. So this is how they have calculated the contribution loss. So sales price of the other unit is 96. And we have given with the cost, we took only the variable cost. Fixed cost, we made it 0. So the gap between sales price and the variable cost would be the contribution, that is 30. But we take only half an hour to produce one product of this other department. So that means for each hour we are taking 2 products they are losing. Agree? So that means this contribution we need to multiply by 2 because we are losing contribution from 2 products per hour. So 30 into 2 would be 60. So that's what they have mapped here. 60 into 51 hours. Are we good? Then the limitations of life cycle costing for pricing. Number 1, it overlooked the external factors. Now we are too bothered about those stuff in life cycle costing. We think about so many stuff. Some are not relevant even. Are we okay? Second one, profit, revenue or market share may not be maximized as again the markup problem comes in. Markup is subjective. Again the same problem comes now. Third one, prices derived from these approaches may deviate significantly from those set by the competitors. Obviously, when you go for the cost-based approaches, you are not that much focused about what your competitor is doing. So if you are not worried about that, whatever your competitor is pricing might be completely different from the answer that you are getting from the full cost plus methods. Are we good? Right. And in these cost-based pricing models, we focus mainly on the cost. We do not bother about the customer's intentions, customer's expectations, competitor reactions, government interventions, in what you call the external environment movements like exchange rate, interest rates. We are not bothering about those. So these will also have a direct impact. But in these cost plus pricing methods, we ignore those. Are we okay? So these are the limitations or the disadvantages of using cost plus pricing methods. Any doubts? Great. Then we are coming to something called economics model. That is where based on the demand we do the calculation. So have you guys heard about the demand curve? Supply and demand. So what we say here is when the prices goes up, the demand comes down. And when the prices come down, the demand goes up. So we are saying we have an adverse relationship between price and the demand. When one moves up, the other one comes down. That is the relationship between price and the demand according to this demand curve concept. You might have learned this in economics, price elasticity of demand. Are we good? Right. This formula also you guys might have learned. P equals A minus BQ. So P is the price at which we have to achieve the demand. A is price at which the quantity is 0. Are we good? So the B would be the slope of the line. That means the movement, the percentage movement of the line. So B equals change in price divided by change in quantity. That's the slope, right? That's the movement. So if you take the formula, then price equals to price when Q is 0, yes, minus the slope. Slope means change in price divided by change in quantity into number of quantities. That would be the basic formula. Are we good? Penny? Sure. Vijay, are you okay? Sorry? Price is the selling price that we are trying to figure out. Then we have a small example here. Alex owns the only bakery in a small town and is the only supplier of donuts. Based on an analysis of sales over the past 12 months, Alex has observed if the price of a donut is $5, demand is 0. So that is A. And for every 50 cents the price of a single donut increases, the number of donuts decreases, price decreases, the number of donuts increase by 20. So for each 50 cent movement in the price, there is a movement of 20 donuts. That's the curve or the slope. So price movement is 50 cents divided by 20 donuts. Are we good? Right. So based on this, like we discussed, A is 500 cents. $5 means 500 cents. B would be 50 divided by 2, which means 2.5. So his curve would be price equals to 500 minus 2.5 Q. 2.5 into quantity, 500 minus that would be the price. Are we clear? Not clear. So 500 cents is where the price is 0 and quantity is 0. Sorry, demand is 0 when the price is at 500 cents. That means $5. That is A. A is clear? Balaji, are we good? Right. Then B. B would be the movement of your curve. So that means your movement in price divided by movement in quantity. So it says for each 50 cents movement, the number of donuts are going to decrease by 20. So that is 50 divided by 20 would be the movement of your curve. That would be the slope of your curve. That would be 2.5. Q is Q. That's the quantity. So your price equation would be P equals 500 minus 2.5 of the quantity. Are we good? Clear? Right. And Alex could use this equation in several ways. Number one, Alex was considering charging 1.5, that means 150 cents per donut. So that means he is planning to price at 1.5. So how much quantity he should sell will automatically come from the formula now, isn't it? For P to be 150, how much would be the Q? Just do the formula. Are we okay? Clear? I'm also thinking about that. I dropped a message, no response yet. Why? You are meeting right. Are we clear on everyone was wondering where are you guys? You got that? But okay. I dropped a message to Srijan as well. I dropped a message for you as well before starting the class. No worries. Right. So, Sindhu, are we okay with solving the equation? Sure. Right. The quantity. In this case, quantity. Yes. For X amount of quantity, how much is the price also we can figure out. For X amount of price, how much is the quantity we need to sell also we can figure out. Either way we can do it. Either we can figure out the price.
The thing we have to do is price is equal to total price meaning total demand at which demand is zero, meaning total
Price at
demand is zero minus
the slope of the curve, that means movement of price divided by movement of quantity.
that is change in price divided by change in quantity.
Correct. Into the quantity.
Into quantity.
Are we good? Right. Then marginal revenue. Marginal revenue means, now we already discussed what is marginal cost, right? In the previous lesson. What is marginal cost? Super. Marginal cost means how much of cost you will have to incur for one more additional unit. Are we okay? Right. Then marginal revenue would be the complete opposite of that. Yes. So it's like
MR is equal to and marginal revenue is equal to marginal cost.
yes. We'll come to that. We have to discuss that as well. So for the time being, marginal revenue means total revenue from selling one additional unit. Are we good? Revenue from one additional unit. Are we good? Right. Then the marginal revenue also we have a formula, that is marginal revenue equals A minus 2BQ. The same formula we put 2 in front. Are we okay? The same formula for price, we put 2 in front of P. Are we good? Right. And this formula, in case if you forget, don't worry, that will be given to you in the exam. That also are we good? Right. Then we have an activity. Company has estimated the following price quantity relationship. So at 40 rupees, the units are 10. At 25, units are 20. At 10, units are 13. Required, plot the demand function on a graph and find out the equation. Find the total revenue function. Find the marginal revenue function. So in the exam, lucky you don't need to plot the graph. If they want, they will give you the graph, similar to BEP. You will not be asked to go for the graph, but even break your point, the CVP analysis. Are we good? Clear? Right. So, if I just put these dots in a graph, it will look like this, a linear graph. It will be always like a linear one. That is how price and demand moves. We expect there is a linear relationship. Are we okay? Clear? Ready? Right. Now, the total revenue. But before that, we have to come to the price equation, right? From that only we can decide the revenue. So, price equation is how much? Number one, we have to figure out A. So, how much is A? A would be 55 according to the trend. Because when your price is going up by 15, the number of units comes down by 10. So at 40, you are selling 10 units only. That means if your 40 will be increased by 15 more, your demand is going to be 0, isn't it? That's the trend according to the numbers given. Agree? Kaushik?
It's a logic or
Usually A will be given to you in the exam. If it is a calculation, then this kind of a logic would be there on the trend. Are we good? Right. So now, 40 plus 15 is 55. At that point, demand will decrease by 10 more units. So demand would be 0. So are we all agreeing that A is 55 then? So according to the trend, when you increase the price by $15, the demand is dropping by 10 units. So at $40 per unit, you have only 10 units in demand. So if I increase the price by $15 more, it will become 0. So A is price at which demand is 0. So then A would be 55. Agree on that? Great. Then we have to figure out the slope. So for that, just get the movement. So price movement is 15, quantity movement is 10. So 15 divided by 10 means 1.5. So quantity. So price equation would be P equals to 55 minus no, that is the marginal price. This is just the price equation. 2 is marginal revenue. Correct. So 55 minus 1.5 cube would be the price equation. Are we okay? But they are asking not for the price equation, they are asking for the revenue function. So to derive at the revenue, what should you do? Multiply the price function by the number of quantities, isn't it? So price function gives you the unit price. So if you want the total revenue value, just multiply it by the quantity again. Agree? So 55 minus 1.5 cube, the entire formula into Q means 55 cube minus 1.5 cube square. That would be the revenue function, isn't it? Yeah. So price function gives unit price. Revenue function means overall revenue. So if I multiply the price function by the quantity, I will derive at the revenue. So then price, we decided the formula is 55 minus 1.5 cube. So if I want the revenue, I have to multiply this entire formula by Q again. So that means I will end up with a revenue function of 55 cube minus 1.5 cube to the square. Are we clear? Kirtan, are you okay?
So we can directly multiply the sales rate. Right.
Can do, but we don't know the sales price right now. No? We are just deriving the formulas. These are just price ranges, right? So we don't know what is the optimum level yet, isn't it? The optimum level would be our concern. So we don't know what is the price at the optimum level yet.
Yeah.
So we have to have these formulas to figure it out. Are we good? Right. So the third one is they are asking for the marginal revenue. So the marginal revenue function would be A minus 2BQ. So A is 55 minus 2 into 1.5Q. Are we good? That means how much? 3Q. Marginal revenue function would be 55 minus 3Q. Are we good? Vijay, are we okay? Suhail? Great.
2 into BQ, why do we find out?
Sorry?
Why you multiply the B by 2 for marginal revenue?
There is a huge mathematical proof for that. In your syllabus, it's not required. The formula will also be given. So this is a bit of a econ side, what we are trying to touch, not the finance aspect. Okay, right. Marginal cost we already know. How much is the cost that we have to incur for one additional unit? We already discussed that several times. So according to economics, all these are linear. And initially, once the output increases, the marginal cost should decrease. Right? Agree on that? But after some point, this economies of scale will be lost, right? Then you will have to invest more to increase the volumes. If you are doing that after the optimum point, when you increase the sales, your marginal cost will also start to increase, because at one point you will lose the economies of scale, isn't it? Agree on that? Right. Therefore, as accountants, our concern is to figure out what is the optimum point. So optimum point is where marginal revenue is equal to marginal cost. That's the maximum we can go, isn't it? If we go beyond that, my cost will be more than the revenue. There's no point of producing more. Everyone agrees on the concept? Sidhu? Right. So then we have another illustration. Variable cost for product Y is given. Materials 1 kilogram at 100, total is 100. Labor 2 hours at 20, so the total cost is 40. Variable overheads 2 hours at 15, so it's 30. Marginal cost is 170. If more than 1000 units are purchased in the month, the supplier will give a 5% discount of all materials. That means now our material cost might come down if I purchase 1000 units. 1000 kilograms if I buy, my material cost is going to come down by 5%. So then how to calculate the marginal cost in this kind of a situation? So without the discount, 170 would be the marginal cost. Agree on that? With the discount, labor cost and variable overhead is not going to change, but our material cost will become 95, not 100, because 5% discount is given. As a result, marginal cost would be 165. Are we agreeing on that as well? Up to this point, is everyone clear? Right. The next point is, if we go for 1000, your material cost is 95. At 95, how much would be the units you require? 1000 units, right? Sorry. Yeah, 1000 units are there. If you purchase at 95, currently, if you are going to incur the same cost, assume the same number of what do you call, kilograms. How much is the units you can go for? 1000 divided by 95. Agree? Right. So 1000 units you can produce. Cost is 95 now. So that means the units you can, 1000 units you can produce now at 950, isn't it? Earlier for 1000 units you need 100. So now your marginal cost between 950 to 1000 we don't know. Up to 950 it will be 170. After 1000, 165. That is also clear. But in between, now we have a problem. Because we have price movement in the middle. Are we clear? Because now if we go for 1000 units, if we purchase 1000 kilograms, up to producing 950 units, we will incur $95 per kilo. That is fine. But after that, the balance, do we have a material cost compared to the original one? Originally, we had 100. So that means 1000, right? 1000 to produce 1000 units. Earlier, the material cost was 100. Now to produce 1000 units, the material cost is 950. That means the gap between these two, the balance 50 units, you are not incurring any material cost as well. If we can compare the original one against the discounted one. The marginal cost means the gap between the original one and the discounted one. No? Agreeing on that? So now, once you get the discount, at a price, at the same quantity, you can produce 950 units. Earlier 1000. For the balance 50 units, now you are producing at a free of charge material, isn't it? Compared with the original 1000. Are we clear? Penny? Sure? Vijay? Right. So that means for entire 1000 units, your material cost would be 95,000. But earlier it was 100,000. But now we have 5,000 gap. You have 5,000 cost savings. Apart from that, you are producing 50 extra units at the same cost, isn't it? For that 50 extra units, then the marginal cost would be without material, isn't it? Because now for material, the extra cost is 0 for that 50 units. Agree? Srujan, are we clear? Right. So if you take the marginal cost for the units between 951 to 1000, only the variable cost would be material and variable overhead.
Labor and variable cost.
Yes. Sorry. Labor and variable overhead. Because material marginal cost is 0. Because for that 50, you are not spending anything compared to the original price. Are we clear? So then if I map, this would be how your marginal cost is, isn't it? For first 950, 170. Anything above 1000, it will be 165, which we discussed earlier. But between 951 to 1000, it is going to be only 70. That is the labor cost plus the variable overhead cost. Do you agree with that?
Second part, so 951 units to produce 1095.
1000 into 95 means you anyway purchase 1000 materials, 1000 kilograms of material at 95. So that you have already incurred. Then the labor cost would be incurring for the balance units also. And the overhead will be incurred. So these two, irrespective of your material discount, you will incur in the same way. So that cost would be anyway there for each product that you produce. But the material cost now, compared to your original to the current one, For 50 units, from 951 unit onwards, there is no material cost until you reach 1000 unit. Agree? Once you reach 1000, yes, again you have to purchase materials now. Then again the cost will start. Are we clear? Sohail, are we good? Kirtan? Sure? Right. Kaushik? Yes, please go ahead.
The thing is, if we for 950 units, how come the material is 1,000?
No, material 1000 we have incurred fully.
We would have incurred, sir, but the thing is, we didn't use it, right?
Okay.
So it will be lying in the inventory. So why should we consider?
No, now we are trying to cost it. So we are trying to price our product. So when we are pricing, we have to consider all the costs that we have spent, right? So for this particular product, for materials to purchase 1000 units, sorry, 1000 kilograms.
951 units correspond to the material we are producing, right?
Yes.
950 units corresponding to the material we are producing, right? So what I can say is, we can take the 951 into 95, right?
We can, but what I am saying is now because of you got the discount, so marginal cost is the gap between your original cost and the current cost. No? So originally to purchase 1000 kilograms, you have to pay 100,000. Now to purchase 100,000 kilograms, you are paying only 950. You have a 50,000 gap. Is that clear? Right. That means earlier, let's assume 1 kilogram per 1 unit for a moment. That means earlier to produce 1000 units, you were spending 100 for 1 unit. But now you are spending only 95. That means if you compare with 100, the previous cost, 950 would be your cost. But now 950 would be the materials you have. But now you have 1000 at the same price. So that means 50 units, 50 kilograms would be like free of charge compared to the previous pricing. So that means for that 50, there is no material cost, isn't it?
Yes.
Because that is absorbed to the balance 950 already.
The parts. The thing is, if we produce 950 to 960 units, the material we require is 960 units, right?
Yeah.
So why not we calculate for 960 units? That's what I want.
No, what we are trying to do is get the advantage of the discount. If you go for 950 units only, then the discount won't be there, right? To get the discount,
So
1000 we have to purchase. So if we purchase 1000, because of the discount, compared to the previous price, 50 units seems to be free of charge. Are we good now? Kirtan, Sujan, Balaji, Vijay, Pranit, Shohit. Right. So if I just summarize the calculation, this is how it would look like, right? Up to 950, 170, 951 to 1000, 70, from 9000, above 1000, 165. Are we clear? The original second page, 95, what you called materials, plus 70 for other variable costs like labor and overhead. This one. The pricing at 95. So after 1000, that would be the pricing, right? So this, in a nutshell, this would be your marginal cost now. Up to 950 units, $170. Between 951 to 1000, $70. Anything above 1000, $165. Are we clear? Any doubt from anyone? Right. Then maximizing profits. Like I told you earlier, because of this economies of scale story. Once you reach a certain point, your marginal cost will also start to go up. So there would be a point where the marginal revenue you get might be lower than your marginal cost. So we can't afford to produce to that level because then we are losing. So we have to find the optimal level, the maximum level. The maximum level would be the point at which your marginal revenue is equal to your marginal cost. Your MR is equal to MC. Sorry?
More like BEP.
Something like BEP, yes. Are we good? Everyone is clear with that? Right. Then usually we use a graph like this for that. So we have jot down the demand and the marginal revenue. Those two would be linear lines. But marginal cost is not going to be linear. We already saw that, right? At one point it was 170, at one point it was 70, and then it went back to 165. So marginal cost is not a linear line. It will be a curvy line. Agreed? Previous one itself evident for that, isn't it? Cost was varying. It's not going to be a line, straight line. It's going to be a curvy line. So this is the marginal cost line in a hypothetical scenario. So wherever you have the intercept of marginal cost and marginal revenue, that would be the profit maximizing output level. Are we okay? Because anything above that, your marginal cost is going to rise. So that means you are not earning the maximum profit you can earn. Anything below that, your marginal revenue is low. You can go for more revenue, isn't it? So again, you are not earning the full potential. So the intercept would be the optimum point for us. Are we clear on that as well? Great. Then how do we go ahead with something like this? First of all, establish the demand function. That's what we did. P equals A minus BQ. Then figure out the marginal revenue. So MR would be A minus 2BQ. That also we learned. After that, determine the marginal cost function. That also we did. After that, you have to figure out what is the point at which MC equals MR. What is the quantity at that point? And once you get that quantity, substitute that for your price function. Not clear? Step 1, pricing function, establish that. Okay? Then to figure out the optimal point, what do we need? We need two things. Marginal revenue and marginal cost. So marginal revenue, we have formula. Use the formula and find the marginal revenue. Marginal cost, we know how to calculate. Calculate the marginal cost. Are we good? Then optimum point would be where your marginal revenue is equal marginal cost. So solve the formula. Then you will get the Q, right? So that is the quantity at which you will have the maximum profit. Take that quantity and use that in your price formula to get the price. So that's what we need to do. Are we clear?
So what is the formula for marginal cost?
Sorry?
What is the formula for marginal cost?
For marginal cost, it's not a formula. We already calculated the marginal cost in the lengthy way. This is what we calculated as marginal cost. So marginal cost, there is no specific formula because it's not a linear line. It's a curvy one. So you have to figure out marginal cost in this way. Are we good? There are other shortcuts. So now we have a small example. The previous one, the activity 3 one, we are saying the total cost is 350, 400 and 450. So 3 different sales points. And the quantity is 10, 20 and 30. Requirement, find the total cost and the marginal cost functions. Plot these in the same graph as the total revenue and the marginal revenue function respectively. Find the profit maximizing output price sales. Okay. So first we have to establish the total cost. The total cost function would be the other way of the pricing function. That would be A plus BQ. Price function was A minus BQ. Total cost function would be A plus BQ. Are we good? Right. So then again, for each 50 rupee increase, sorry, $50 increase in the price, unit is coming down by 10. We agreeing on that? So if I price at what, then it will be 0. I mean the cost. So our formula is TC equals A plus VQ, right? That's our formula. And here A is the total fixed cost, the overall fixed cost, because our total cost is fixed cost plus the variable cost, right? A is fixed cost. Then B is the variable cost or the marginal cost per unit. Q is the output. And to figure out B, the variable cost or the marginal cost, we can use a method called high-low method. This is a shortcut. Are we good? Clear? Right. So the shortcut or the high-low method would be the total cost at the highest output minus total cost at the lowest output divided by units at the highest output minus units at the lowest output. So we are getting the movement of cost divided by movement of profit. Sorry, movement of units. Are we clear? Kaushik, are we good? Sujan? Right. So what is our highest cost point here? 450. What is our lowest cost point? 350. So what we took? 450 minus 350 divided by the movement in output. At the highest point it's 30, at the lowest point it's 10. So the movement is 20.
So in the question, sir, when the cost is increasing, demand is increasing, right?
Cost is increasing, the quantity will increase. It's not the revenue we are talking about. Okay? Right. Right. So then marginal cost per unit would be $5.
That's the way to find margin.
It's a shortcut. It doesn't give you the exact marginal cost, but it will give you average marginal cost. Are you okay? Right. Better to go ahead with the highest and lowest, because sometimes in the middle the pattern might change. No? Always, I mean, it's linear, but even on the linear one, in the middle, sometimes the pattern might change. 95% of the time, whatever the two movements you take, answer should be the same. But that 5% is always there. Better to go with the highest and the lowest. Are we good? Right. So now we know the variable cost, isn't it? So total cost equals fixed cost plus variable cost. If we change the formula slightly, fixed cost will be equal to total cost minus variable cost. That also can be said. Right. So now we take 30 units as our level. So if 30 units is our level, 450 would be our total cost. Marginal cost would be 300, 30 into 5. Are we good? Sorry, marginal cost would be 150. 30 into 5. Agree? Then my fixed cost would be how much? $300. Are we good? Clear? Okay, so I got a request that the entire sum was not clear. I'm just going through once more. Right. Simply, we are trying to figure out what is our cost function, first of all. We need to do that. So to figure out the cost, we have a separate formula, that is total cost equals A plus BQ. So that means your fixed cost plus variable cost. A is fixed cost, BQ is your variable cost, right? So fixed cost we don't know in this calculation. Variable cost we know, that is your marginal cost. To figure out marginal cost, we use a mechanism called high-low method. So under high-low method, what we do is we take the movement of price or the cost divided by the movement of quantity at the lowest and the highest levels. So according to the numbers that is given to us, the highest cost is 450, the lowest cost is 350. So the gap is 100. When you come to units, highest is 30, lowest is 10. So that means 20 units. Once you solve the formula, 100 divided by 20, you get $5 per unit as the variable cost or the marginal cost.
The graph would be 100%.
It can, it can be a formula given to. If they have given the graph, yes, nothing to worry, you just have to get the intercept. But sometimes they might give the graph, sometimes they might use the formula method. We have to be prepared for both. Are we good? So, we don't know which method that they are going to ask. If they go for the graph method, the graph will be there. Then question will not be on finding the the best output. Because in the graph, like you said, the intercept gives you the exact answer. So it would be some other interpretation, like if the price is going up by this amount, how much would be your cost, or how to manage the price, that kind of a question. If it is a formula driven one, then even this might be a question. Are we okay? Right. Coming back. So marginal cost, variance cost, variable cost, we understood as 5. So we don't know the fixed cost, but we know the price ranges or the cost ranges and the units, right? So we can use one of those stages in our total cost formula, isn't it? So my total cost formula is total cost equals to fixed cost plus variable cost. Now I'm going to subject the fixed cost. So fixed cost in that case will be equal to total cost minus variable cost. So total cost, if I take 1 point, the last one, the highest point, 450 would be the total cost. Marginal cost would be, we are selling 30 units at that point, 30 into 5. So that means 150. So 450 minus 150 will be the fixed cost. That is $300. So now we know the fixed cost and the variable cost. Now we can go for the total cost function again, isn't it? Since it's a linear one, it should be the same.
450.
Okay, so if you use 350, then 350 minus 10 into 5. So 10 into 5 means 50. So then again 300.
Okay.
So since it's a linear one, doesn't matter which point you pick. Always the answer should be the same. Are we good? Ahmed, are we okay now? Right. So now I can substitute the numbers I figured out on the total cost function. So fixed cost I know 300. Marginal cost I know 5. So my total cost at any given point would be 300 plus 5 into the quantity. Agree? So 300 plus 5 cube would be my total cost at any given point. Are we okay with that? Okay.
Yes.
Right. Sorry. So then the total cost function, you can just use it and derive at this graph. So like I said, the graph is not required for you to draw. So don't too much worry about the graph in this section. If you
They given it to the answer.
but like I said, if they give the graph, they might not ask the optimal point. Question would be something different, like if this is the quantity, how much would be the price? Yeah, it will give a hint, true. Are we good? Right.
You have the cost is linear, right? How much is not right?
Total cost would be linear.
Variable cost will be, sorry, marginal cost will be.
Yes. Are we good? Right. Then, to calculate the profit maximizing output, marginal revenue equals marginal cost. So, marginal cost we already know it is 5. For marginal revenue, we developed the formula in activity 3, right?
A minus B.
Yes, for that we had the answer 55 minus 3Q. We had the answer there. Recall?
Activity 3 is the.
Yeah, under activity 3. Function.
Total function, marginal function.
Yes, so marginal function was A minus 2BQ.
For this also, it can take marginal function also. Marginal cost, marginal cost function.
Marginal cost we already calculated, right? So no need to recalculate it. We already calculated it as 5 no? In activity 4. Yes. So we are using the same 5. In activity 3, we calculated a formula for marginal revenue, which was 55 minus 3Q. Now, if I shuffle it around, 50 would be equal to 3Q. Agree? Ready? Right. So if I divide it by 3, it will give my quantity, isn't it? So 50 divided by 3 would be 16.67. So my marginal quantity would be 16.67. Then profit maximization, again we had the formula. 55 minus 1.5 into 16.67, the price formula. Remember? So then you get the maximum or the optimal price as $30. Are we clear? So is the process clear to figure out the optimal point?
Only thousand what is that? Comparing those things, it's like
Process is clear? Right. So process is very simple. First, define the revenue function or the price function. Then define the marginal revenue function. Define the marginal cost function. Equal those two and figure out how much is the optimum quantity.
so marginal cost, we assume the form is
That is the total cost. For marginal cost, we use the high-low method. The movement. Are we okay? Right. Then once you get the optimal quantity, replace that as Q in your price formula. That will give you the optimum sales price. Are we clear? Sure. Great then. Good. Sujan? 100% sure? Your face says a different story.
Little bad.
Might be tested.
For the cover maximum to maximum 6 months.
It depends. If I have the examiner, I can put it for 20 marks also.
Sir, you are just asking previous attempts.
Based on an average, maximum they have gone around 10. But don't forget 10 guys. Like I said, even 1 mark is very crucial in the exam. So,
This one is very
not accounting, no, it's more or less economics,
theory-based.
statics. So I know you hate statics, but we cannot ignore this one. True. Not mine also, but yet we have to study.
APM also.
No, APM, these kind of stuff won't be there.
Okay, or
APM, it depends on how you see it. So if you are okay to see the strategic aspects of a business, APM would be very easy.
but once we correct those metrics, we have to complete those two.
If you want, you can do the others also.
We can switch in between.
Yeah. If you fail APM, then if you want to shift to APM, sorry,
Last four exams, vector written or computer.
last two exams.
Last four. Professional exams. And other professional exams, or computer-based exams or written exams, paper-based.
Again, computer.
Computer.
Yeah. Are we okay up to now?
There's no other way to find marginal cost.
We have the tabular format. Tabular format. We are coming to that now. But trust me, this one is easier. It's just that since we did everything at a stretch, it's too much to grasp. I can understand that.
Transformation output is MR.
Yes,
But equally, this is MR.
both are same. At equilibrium only, your profit will be maximized. If you go above that, your marginal cost will be going up. So your marginal cost is going up means your profit is coming down.
But the thing is, equilibrium means sales and the cost for the equal. So there is no profit.
No, that is in demand curve. In marginal cost curve, equilibrium means your profit maximization. So two different aspects we are talking about. So it's like if you take the cost, going up is problematic, right? But if you take the revenue, coming down is the problematic one. Going up is better. So even though we are talking about intercepts, based on the numbers or the figures that we are looking at, the meaning would be different. The interpretation would be different. In the supply and demand curve, there is no, it's break even basically in supply and demand curve. In marginal cost demand, that is the perfect scenario. Because above that, your marginal cost is going up, so your profit is coming down. Below that, you have the capacity to increase the price more, but we are not increasing. Yes, that's the highest profit. So I'll prove that in the next example. Up to now, are we okay? Like I said, I know it's a little bit too much to grasp for a day, but unfortunately, the time we have is limited. So I can't waste the time. Correct. So I have to do the maximum that we can do for a day. But once you look at these examples once more, trust me, this will be much more easier for you all. Because when I was a student, also when I was listening to lecturer, this was like a Greek for me. But after I looked at sums once more, I was okay with that. And I felt it's actually easy compared to activity-based costing. If you get a sum of this will be much more easier to score than the activity-based costing calculations. Are we good? Right. So now we are moving on to a tabular approach. This is an alternative method for the one that we have previously discussed. But the only reason why we are using the tabular approach would be either we don't have sufficient information or the relationship between the prices are not linear. To go for the graph, guys, can we focus? So in the graph, if we are going for the graph, at least marginal revenue should be linear, right? There should be a linear relationship at least on the marginal revenue. Otherwise, we can't do it. In the formulas, if you can have a straight line, Doesn't matter the slope. If you can't have a straight line, we can't do the previous calculation, right? Agree? But there would be instances where the revenue and cost might not move in a linear curve as well. It might have a different shape. If that is the case, previous approach we cannot use. Are we clear? In such a scenario, we have to use the tabular format. This will not give you the precise answer. Previous format, the graph gave us a precise answer. Tabular format will not give you a precise answer, but that will give you an approximate answer.
For marginal cost, sir? What the marginal cost?
No, for the optimum point. So marginal cost would be one component in that.
So we can study any one.
No, because in the exam they can specify which approach you have to use. And they always recommend to go for the graph approach because that gives a more precise answer. Tabular approach gives you an approximate answer. Are we okay? Right. So let's see how to deal with the tabular approach. So based on the information given on activity 3, they have put it into one table. At 10 units, selling price is 40, total revenue is 400, total cost is 350 and the profit is 50. Agree on that? Similarly, at 20, selling price is 25, total revenue is 500, cost is 400, so the sales is 100. At 30 units, selling price is 10, total revenue is 300, cost is 450, and you are having a loss of 150. So what has the highest profit? Quantity would be 20, right? And if you check at the 20 level, your marginal cost and the gap between your marginal cost and your marginal revenue is also less.
Revenue.
Isn't it?
Yeah, okay.
The gap between your marginal cost and your marginal revenue is very less at 20 output level. Are we clear?
But in 10 output level, there is 50, right?
Sorry?
You output 10, we have.
Yes, that's why I told this is not giving the precise answer. This is giving an approximate answer. For the precise answer, we have to go for the formulas and the graph. Are we good? So this precise one gave us 16.67, right? But table gives us 20. That is the approximate number. Are we good? Right. So according to the table, it says $25 per unit would be the ideal price, whereas the precise method told us 30 would be the ideal price. So a table gives us just an approximate number. Are we clear? Ketan? Sure? Right. Guys, if you are not clear, please raise it. At least go home, check again, at least raise it tomorrow if you are not sure today. Are you okay? Because I know some of you all are not, some of you all are comfortable with revamping. So do the revamping part as well. Even after that, if you are not comfortable, please make sure you raise it tomorrow and clear it out. Don't ignore any topics.
So we complete this chapter today.
That's the target is, but I'm not sure based on the time. Let's give it a try. Seems like we can't. So then we have another example for the tabular format. We have a baker who has just introduced a new type of cake. He has been experimenting with the price to determine daily demand. On each of the last 10 business days for which he charged different price, he recorded actual demand and the production cost. So the breakup is given: price, quantity, and the cost. Using the tabular approach, calculate the marginal revenue and the marginal cost for each price of output. So let's see. We have the price, quantity. Price into quantity would be my total revenue. Then I can take the gap, right? At each point, how much is the incremental revenue? That would be my marginal revenue. Agree on that? Right. Cost also I can do the same thing. I can have the total cost. Each point, the gap in the cost would be my marginal cost. So that means, for an example, the gap between these two would be 380. The gap between these two would be 185. Likewise.
When the point increases,
Sorry?
when the point is increasing, the margin revenue and cost will get right.
Yes. That's what happening here.
Cumulative.
Cumulative figures. So this is cost wise. So at each point, how much is the difference? 300 is the difference between these 2 points. 179 is the difference between these 2 points. Are we clear? Sujan, are we good? Right. So now if you check this diagram or this table, at what point your profit is maximum? Okay, we don't have the profit. At what point is your marginal cost is close to your marginal revenue? What is the closest point? Six is more closer, right? The gap is very less. 186 and 180, only 7 units. So that means your optimum solution would be around here. Yes, approximately it would be around here. Are you okay?
Something around 5 or 6.
Yes, you can't go for 7. Yes, because if you go to 7, your marginal revenue is decreasing like nothing. From 187 to it come down to 71. So 7 you can't go. Should be between 5 and 6. But in realistically, we can't have decimal products, right? So it would be a full product. So then 6 would be the ideal one, even though it is the approximate value. Are we good? Kaushik? Sure? Keep that? Right. Then you can just calculate the profit also and see what will happen. So this is how the profit is. Now I calculated the profit for each level. Then where do we have the highest profit? Again unit 6, right? So haven't I proven? Now I have proved, right? Wherever the margin gap between marginal cost and the marginal revenue is less, the profit is high. So here also, this would be the profit maximization point. Are we clear? Any doubts?
Do all this table or like, our cumulative.
In the tabular format, just draw this table. Yeah.
Okay.
And figure out where do we have the least gap between the marginal revenue and the marginal cost. We have, but for that we can't do it in an Excel. It would be a very simulation process because few variables are changing, not only one. So in an Excel we can't do that. For that we should have a simulation method.
Can we use ArP&x in Excel?
You can, but not in the exam. In practice you can do, but not in the exam. Guys, let's focus. What are the disadvantages of this economics model? So, number one, how to do this, what do you call, estimate these demand values and the supply values. It's again subjective. These are not fixed theories, right? How to fix your demand and how to fix your supply. There is no fixed mathematical model to do that. So that is going to be a subjective function once more. So again, you have a question mark. Second one, demand curve always overlook the variables external to the company. So the internal factors now we are disregarding. Earlier it was other way around. In the cost plus methods, we were thinking internally. We simply ignored the external factors. But in economics model, we are doing other way around. We are focusing more on external factors, but mostly we are disregarding the internal factors. Then, in reality, certain products, the demand and supply might be interconnected. But we are not considering those stuff here. We consider each product is independent. But in reality, that might not be the case. For an example, toner and the printer, or the cartridge and the printer. Isn't it? It has an interrelationship. But we cannot quantify that in this method. So we are disregarding those factors. Finally, apart from profit maximization, other strategies also might be there for a business, like market penetration, market capturing, increase the market share, brand loyalty. These kind of additional factors also might be there, which we cannot cater into this model. Are we good? Right. Then, okay. The balance will not take a lot of time. Can you guys give me around 15 to 20 minutes max? No, it's not complex. Just few theories, philosophies are there. What we studied are complex. The rest is not that complex. Most of the stuff you know already. Can we? Only 15 to 20. If it goes beyond that, I'll stop. Okay? Whether I keep continuing to keep choosing that word. Right. The production and sales levels. Usually, when the production increases, there would be additional costs involving, like space. For inventory, you need additional space. So when the production goes up, your inventory also goes up. Unless you are into JIT, just in time, where you just produce for the demand. If it is not the case, once the production goes up, your inventory of finished goods will also go up. Exactly. So your overall production cost might increase. Second one, the selling price significantly influences the demand. That is a given thing. Next one, production escalations, like things like customers might think about alternative products, and decline in sales prices, damage to the brand reputation. These are the ones that we have to consider when we are doing our pricing apart from the costing. Are we good? Okay, the word gives you energy, no? Shape? Right. Now, what are the other market strategies? Number one, market skimming. So, market skimming is a strategy where you can simply launch the product at a higher price, at a premium price. So, there are a set of customers who would like to purchase this. Once that demand is over, gradually we will reduce the price. Can you give an example for that? iPhone. Best example is iPhone for market skimming. Initially, when you launch a new version of iPhone, the price will be very high, because there would be a set of people who wants to be one of the first to purchase that. It gives them a social status, a satisfaction. So we keep the price higher to get the maximum out of them. After that, the general public will not go for that high price, right?
Choose the
Yes. To address them, gradually we try to reduce the price. So with the passage of time, my price I am decreasing. So this is known as the market skimming. So this is more precise or can be used properly when there is less competition in the market and your product is something completely new or having new features and customers are more towards social prestige. In that kind of a market skimming can be done. That's what Apple is used to do. Are we good? Okay? Right. Okay, shape means okay, cool. So that's why I'm saying always shape now. He says it gives him energy. So I keep using shape now. The next method is market penetration. This is the completely opposite of market skimming, where you try to launch the product at the lowest price. And then gradually, when the customers start to know your product, when the customers build up the loyalty with your product, you gradually start to increase the price. Any example? One plus. Yes, correct. That would be the cheap end of alternatives of mobile phone, smartphone market, right? So they initially launch at a lower price. But once people get to know the product, gradually they start to increase the price. Are we good? So this will be more helpful when you have huge competition because you need to capture the market share. And your customers are not looking at the prestige, they are looking at the price. Whatever cheap, they will go for that. And there are a lot of alternatives in the market. In that kind of a situation, market penetration would be the ideal scenario. And if you take the product life cycle, if your product life cycle is very short, skimming would be the best way. Because beginning itself, you will try to capture as much as possible from your fixed cost. But if your product life cycle you are expecting to be a little bit more lengthy, maybe penetration is good for you because you have more time to recover your fixed cost. Are we good? Right. Then contemporary products. Sorry, complementary products. Sorry. Complementary products means these are necessities. These goes one product goes with another. Best example, printers and cartridge. If you bring a printer, you need to have a cartridge. Then what you can do in your pricing if both are produced by you? You can keep the printer at a lower price and cartridge at a higher price. Because after the customer purchase the printer, he don't have an option. He have only three options. Either to purchase cartridge at whatever the price you say, or forget about the printer and keep it aside, or you have to go for another printer itself. These are the only three options you have, right? Last two are unlikely. After you take a printer, the possibility of just keeping it aside is very less. And just because of the cartridge, going for a new printer is also unlikely. So most probably customers will buy the cartridge. So whatever the loss or the loss of income that you have from the printer, you are trying to capture it from the cartridge. So this is known as complementary products. Two products goes together, and when we are pricing, we try to use that to our advantage. Are we good? Next one, price discrimination. This is where for different markets, we give different pricing. Can we do that? We can. Depend not just on the country, we can do country-wise as well. For India, we can give one price. For America, we can give another price. We can do that, isn't it? That's why this drop shipping is evolving these days. So you just purchase from somewhere at a lower price, probably from China, or some materials even from India. Then they sell it at a higher price, but the people who are purchasing from us doesn't have the access to Chinese or Indian market, or they don't have the expertise to purchase from Chinese or Indian market. That's why this dropshipping is coming up, right? Because we have this price discrimination. Are we clear? Right. So examples for price discrimination is these mobile phone packages you have.
Data packets.
Yes, data packages you have. For students, you have a different package. For government employees, you have a different package. For professionals, you have a different package. So aren't you discriminating different prices for the same product for different markets? It's product discrimination, isn't it? But it is used very effectively in the telecommunication industry. Clear? Shaped? Right.
We can also say the industries for the defense things.
Sorry?
Industries are used for defense.
Interest. What do you mean? Yes, can do. Yes, banking also it happens. For senior citizens, a lower rate. For professionals, a lower rate. For students, a different rate. Students loans. So yes, that can be done in bank loans as well. Right. The next one, loss leaders. Loss leaders is where we sell a product at a loss to attract the customers. Do we actually do that? Yes, we do. In certain cases, we do. To start with, we go for a loss. But we create a loyalty to such a level during that loss period that the product will not be known for the customer, but the brand will be known for the customer.
Brand.
So that's what's happening in certain products, right? I'm not sure about India, but if you take Sri Lanka, there was a time where if you take milk powder, people knew only one brand. That was Anchor. So they were not asking for milk powder, they were asking for a packet of Anchor. So that's the level of branding you can do. So people doesn't know that there are alternatives even. They go for the particular brand. They are aware only about the brand. Are we good? In India, Lay's would be an example. Whatever the potato chips you are using the name Lay's, right? You go for the shop and ask for a Lay's, isn't it? But sometimes it's not a Lay's actually you are purchasing. But the name that you are used to is Lay's. Agree? So that is loss leader. You incur a loss and you create such a brand loyalty where your customer will stick to you, then you will increase the price. Because now you know customer will not go out of you. That's what Nokia was also trying to do. But they unfortunately failed. Are we okay? Right. Then going rate price, that means you are going to go exactly with the market rate. Nothing to think, you just adopt the market rate, that's it. So if you are using the market rate, that means you have a heavy competition and the market is very sensitive to the price. Then you don't have an option rather than going for the market price. If you go for a market price, what is the best costing method you can use in a market like that? Sorry?
Low cost.
Low cost. Okay, good.
Target customer.
Great. If you are into a market like that, target costing would be the ideal method because sales price you can't change. You have to go for the market price all over. You take that, take out whatever the margin you expect, get the target cost, try to align your cost to the target cost. That's the best mechanism if you are in a going rate pricing. Are you okay? Right. Next one, product line pricing. That means this is where you are trying to sell more than one product at a time. For an example, bundling. So if you guys, since you guys suggested, I tried browsing through Swiggy and all. So there were so many options where products are bundled together. And today morning I saw that if you purchase Red Bull, Lay's will be given free or something. combos. When it comes to meals, combos. These kind of stuff you are combining together, right? But if you take separately, the price will be higher. The combo would be at a lower price. So this is known as product line pricing. You are not pricing for one particular product, you are pricing for a bulk of products. Are we good? Right. Next one is volume discounting. So this is where if you go for a higher volume, if you purchase more than this amount, we are giving an X amount of discount. That is also common in the market, right? Volume discount is also usually given to encourage overall volume, to encourage for more volume at a lower price. So this is again giving, this will be also given in a very competitive market. Otherwise, you don't bother about that, right? You are bothering about that because you have a heavy competition. So volume discounting will also be applicable in a highly competitive market. Are we good? Okay. Right. Then relevant cost pricing, we already know what is that. Just take the relevant cost and go for the markup. Are we good? Okay. The final part we will do on the next class.